Mistakes people make when investing in the stock market. That's the topic for today's episode. And without further ado, let's dive in. Hello, everyone, and welcome back to another episode at Novarize Invest. For those who are tuning in for the first time, this is your channel for financial education. So today we're going to talk about the stock market, right? What is it that you need to be on the lookout for so that way you don't make those mistakes that are going to end up costing you a lot of money and creating a lot of headaches. Now, before I go into the board, I want to clarify something. There's two ways to invest in the stock market. There's the long-term way and there's the short-term way. Investing in the stock market for the short term, it's going to be a topic for another episode because it's completely different from what I'm about to show you in today's video, which is all about investing for the long term. That's how I invest in the stock market. So I'm just going to create this episode to speak about my experience and the lessons learned that I've acquired over the years investing in the stock market. So now that we got that clear, let's just go straight into the board. So what's the number one mistake people make when investing in the stock market for the long term is that they fail to do their due diligence, right? So fail at their due diligence. And by the due diligence, I'm talking about the fundamental analysis, right? So what's the fundamental analysis? Is just basically what the word says. The analysis of whatever is it that's fundamental. What is this company doing? Are they planning to reinvest the gains? Are they planning to expand overseas? Is it locally? Are they planning to hire more people? Are they investing more money in research and development? You need to understand all of that. It's kind of like the equivalent of the market research when you're investing in real estate. You need to know what area you're investing in. I'm sure you've heard from HGTV that it's all about the location, location, location. It's not so much about the house, but the location. You can have the nicest house in the area, but it's located in the middle of nowhere. Guess what? You're not going to have any luck with it because nobody wants to drive an hour to get to the closest Walmart, right? So that's the same analogy applied to the stock market. So you should definitely keep that in mind. Now, mistake number two that people make when investing in the stock market is to always want to get short-term gains, right? Want to get short-term gains. And why do I focus so much in short-term versus long-term? Well, there's something that the IRS code refers to as capital gains, right? So what happens with capital gains is that when you have an investment and you hold it for longer than 12 months, you pay a different tax bracket as opposed to someone selling it in the short term because that's actually taxed as ordinary income. So anything that's longer than 12 months gets a lower tax break. So whenever you wait, time is your friend in this case, longer than 12 months, you can lower your tax rate on the gains every time you sell the stock down to 0%, sometimes even 10, sometimes even 20, depending on your tax planning and your tax strategy. But if you don't do the proper planning and you're desperate to just get short-term gains, so let's say, for example, you bought stocks in January and now all of a sudden in June, you want to cash out of them because you're seeing the growth and you want to get some money out of it and you sell it in June. Now that money is taxed at an ordinary income level, and that has the highest tax bracket out there, and that's up to 37%. So you're, working your butt up, you're doing all that research, doing the best you can to make a gain, just that when you sell it, Uncle Sam comes in and takes 37% out of your gains. Not fair, right? So that's why you have to play the time game. This is a game of time, right? And that actually takes me to my next point. Another mistake that people make is to not have established business, okay? And I know we're talking about investing in the long term and all of that stuff, but sometimes, we do this on a full-time basis. Sometimes you're at home trading on the stock market left and right because that's all you do, right? It's kind of like the equivalent of a flipper. You work and you constantly in the middle of everything, in the middle of the action, and you get it done. And just like in real estate, I have usually said that when you're investing in real estate, you should place your property on an LLC, not only for asset protection purposes, but it also because it helps you build business credit. And at the same time, it allows you to take all the deductions that a business can generally take. In the real estate example, it will be the fees paid for the property management, any maintenance costs, property taxes, the interest on your mortgage, and yada, yada. You kind of get the picture, and the depreciation, right? This is no different than when you're investing in the stock market, because you can actually set up a business. In this case, it will be an LLC, right? LLC. And when you do that, you can actually deduct home office expenses. Could be the desk, could be the chair you're using, could be the computer, could be the courses, could be the books that you're reading to, continue to enhance your knowledge in the field. So you can actually deduct all of that so that you can reduce your taxes legally in a way that you can maximize your gains while you are investing in the stock market. Now, for those who want to learn more about LLCs or, getting access to a point of contact that can help you get the LLC set up, I'm going to leave the links down below to a playlist that you can actually watch and learn all there is to learn about LLCs. Now, back to the board. Another mistake that people make is to not reinvest dividends, right? So what is a dividend, you might be wondering? Well, think of it as cash flow, right? So when you buy a rental, you get cash flow every month. So with the stock market, you can actually invest in stocks that can give you dividends on a monthly basis, or perhaps on a quarterly basis, maybe every 6 months, maybe yearly. It all depends on the company. And so what a lot of people don't know is that sometimes they have invested in stocks that provide them with dividends. And when they receive the dividends, they don't do anything with it. They just leave it there sitting in their brokerage account. And you don't want to do that. You actually want to go ahead and click on the option that allows you to reinvest the dividends. And what it does is that every time you get the dividends, you're reinvesting it back into the company. And you're also helping the company grow faster, and also your investments grow faster. Now, on to the next point. And I just realized that I ran out of space here. So while I get the board cleaned up, why don't you go ahead and hit the like button right here to help this episode rank and help other people like you looking for information of this kind. And if you have some additional spare time, why not? Subscribe to the channel so that way you can stay tuned to more episodes like this. Okay, so we got a clean board, so let's move on to the next mistake. It's spending your gains in bad debt, okay? That's a very bad one. If you've been following me for quite some time, you've probably checked out an episode where I talked about how to start investing in your 20s so that you can become a millionaire by the time you are 30. And in that episode, I actually talk about how you, from a very young age, you can start investing in the stock market with a smaller chunk of capital. And I emphasize the stock market because it usually has a lower entry point, which it makes it easier for people with less budget go in and start building their equity until eventually they amass a certain amount of money and they can actually use that capital that they have managed to create and invest it in real estate. And that's how you eventually wind up getting access to your very first property. So when you do that, when you take your gains and you do that, that's you investing in good debt. However, there's some people out there who don't understand that concept and they invested in bad debt. What is bad debt? Bad debt is whatever debt that requires you to work your butt off to pay it off. So using your gain and actually partying all that money away in one night, or spending it in Gucci shoes that don't necessarily create any passive income whatsoever. Now, with that, I'm not saying that you shouldn't enjoy yourself, that you shouldn't go out there and celebrate life or buy yourself a nice splurge because you have worked very hard. But there's something called timing, right? You have to wait for the right timing. When you are in growing mode, you shouldn't be spending money like that because you're taking capital away from building your future. You want to use that capital wisely so that way you can build something, and eventually once that passive income is flowing in and coming in, you could probably splurge yourself a couple of things here and there and celebrate your effort and the product of your sacrifice, right? The next mistake people make, it's always wanting to time the market so you can buy low, right? Buy low. No. Yes, it's true. There are a lot of people who focus on buying low. They do all the technical stuff where they look for the highest, the new high, and then the new low. That's great if that's how you're investing in the stock market. But when you're investing for the long term, your best friend is time. So you cannot afford to be waiting for the next low, the next cheapest moment, because what you want to do is just to get in as early as possible and let time help you compound everything you have been accumulating over the years. And even if there's a market correction, let that correction be weighted out because you're letting time go by. So forget about trying to time everything so you can buy it with the cheapest, amount of premium possible. Forget about it. Time is your friend. The earlier you start, the better. That's why the episode, the old one that I was talking about, was titled How to Start in Your 20s so you can be a millionaire in your 30s, right? Now, moving on to the next step, and that's has to do with the complete opposite. Wanted to wait for the highest price to sell, right? And that's actually a big mistake right here. That's how people get wiped out, okay? Because it is very nice to see your graph or your portfolio going up like this, right? And people get greedy sometimes. Emotions take over and you let it keep going up and up and up. And you're like, almost there, almost there. Let me just wait a little longer. Let me wait a little longer. But you know what? You don't have a magic ball. And next thing you know, downhill, everything. You have lost everything. You can't afford to do that. You're working very hard. So let's just be smart about it and let's just set aside the emotions and stop being greedy, right? So the way I approach this, right, is that I always set a number, a goal, right? I study the market, I do my analysis, and I say, you know what? I'm just going to wait for this stock to hit, I don't know, maybe 500. It might not be the highest, but it's the target that I wanted. And once I hit the target, I'll just get out. I'll just get out because I don't want to deal with it. And that's you having clear set goals and investing based on fact, based on numbers. In fact, I actually did this with Bitcoin. And for those who have been following me quite some time, I have a love-hate relationship with Bitcoin. I like it, but sometimes I don't like it because I don't understand it and yada, yada. And so I invested in Bitcoin and I remember buying into it when it was 12,000 years ago. I was happy just like everybody else. I was excited because you get to, make a quick buck in and out really quick. And next thing you know, boom, it just fell. Not pretty, right? And so what I decided to do was just to wait it out, just like I normally do with the stock market. And, I have plenty of time and I'm busy with other things and invest in real estate. So let's just let it ride. And when I started hearing in the news that Bitcoin was actually making a comeback, I said, you know what? I'm not going to sell at 12 because I know this comeback will probably mean higher money. And if not, then I'll just leave it there and wait for another couple of years, right? And so my forecast was actually accurate and Bitcoin hit 20,000. So that was my goal. As soon as it hit 20,000, I sold. Now, I know some of you might be saying, oh, but is it 40 something or 50 something, depending on the time that you're watching this video. This video is being released in October of 2021. But depending on the time you're watching, Bitcoin might be different at that point in time. But to me, it didn't matter because I said that was my target. And that's how you keep your emotions in check and you don't let greediness take over you. Now, back to the board, talking about emotions, right? The next mistake that people make is to fall in love. That's a heart right there with the company. It's horrible. Why? Because your emotions are clouding you. You're not thinking straight, right? You are in love. So therefore you see everything beautiful in your eye. There's actually something very funny that I wanted to share with you. I was watching an episode of Friends a couple of weeks ago. And it was quite fun. And it was about an episode where Rachel gets to meet up with her sister. The role that was actually played by Christina Applegate. And so in that episode, the Rachel sister, it's looking into transitioning into a new career. And she decided to become a baby stylist. You cannot make stuff up, right? So, she meets up with Rachel and Rachel is walking down the street and asking her, hey, how's the baby styling business going? And she goes and says, I don't know. I don't understand why people don't want to admit or understand that their babies are ugly. And when you come to think about it, it's like, well, parents, babies, all the babies in the world are beautiful. Every baby deserves to be in a commercial. Every baby deserves to be a Gerber baby, right? But you kind of understand the analogy in here, right? Don't fall in love with the company. Otherwise, your judgments are going to be cloud. And if it gets to that point, just take a step back, ask yourself, why did you invest in this company in the first place? And then go over the numbers. Keep everything fact-based. Once you focus on the facts, the picture will be crystal clear. Okay, now back to the board and going into mistake number 9, and that's having a lack of diversification. Now, I don't know how I feel about this whole diversification thing, right? But I decided to throw it out there because that's what everybody likes to talk about. To me, true diversification is when you invest across all asset classes, meaning in a business that gives you cash flow in real estate, precious metals, the stock market, and commodities, right? Now you're truly diversified. But sometimes people don't do that. People focus on diversifying in the stock market. And to a certain degree, that's true. You should diversify because if something happens in one field, you want to make sure you're protected. Now, me personally, diversifying your stock portfolio is not really true diversification because your money is still in one asset class. And in this case, that's the stock market, right? But let's assume that that's what you do, that's what you're really good at, and you're specialized in it. You should think about diversifying your stock portfolio. Let's say you should have a certain share of your portfolio in tech stocks, some of them in retail, some of them in commodities, yada, yada. Because if something were to happen to the tech stocks, you will still have the retail and the commodity stocks to fall back on, and vice versa, you know? So that way you're well-rounded, you're fully protected, and that if there are losses in one side of the equation, the other side of your portfolio can absorb some of the losses and, you know, help you stay afloat. So that's pretty much all I have for you today. Hopefully you found this episode very valuable, and do not forget to share the love, share this episode with someone like you who is looking for information of this kind. And while I still have you here, do not forget to check this episode right here. That's going to help you complement pretty much everything you just learned today. And until then, I'll see you guys soon. Take care. Bye-bye.